In today's video, we're gonna list the 10 best investments you can make ranked by profitability. We are going to see the best options you have, starting from conservative investments like bonds or the money market to riskier ones like real estate, or even becoming investment sharks like Mark Cuban or Kevin O'Leary. And yes, you'll be able to do all of this even with just $1,000 or less. My name is Rick, and if you like finance and investing, this is the right channel for you. So subscribe if you wish, and I'll do my best to give you value every week. Alright, starting with the number 10, we have commodities. Commodities are, for example, gold, silver, even oil and natural gas, and of course, you can buy gold and stuff it under the bed, which can still be considered an investment, but the easiest way to invest in precious metals and other commodities is by opening and using a brokerage account. If you prefer using a phone, you just need to download an app like M1 Finance, Robinhood or Webull if you're in the US, or Trade Republic or Trading 212 if you're in Europe. And you can buy them in different forms. Probably the easiest way, and in my opinion the one you should focus on if you really want to invest in commodities, is by investing in commodities ETFs or exchange traded funds. An ETF is a fund that holds ownership in many different companies, and in this case of commodities ETFs, it would be a fund including companies that do business in the commodity sector. For example, an oil ETF might include shares of large extraction companies, support companies, and oil distributors. But now, the hard truth. A commodity is a silly investment. That's why I put it at number 10. But to understand why it's a silly investment, just listen to the words of Warren Buffett himself.
If you buy an ounce of gold today and you hold it 100 years, you can go to it every day and you can coo to it and you can caress it and you can fondle it. 100 years from now, you'll have 1 ounce of gold and it won't have done anything for you in between.
Number 9 is mutual funds, which is a type of investment fund managed by an investment manager for you. So you buy a mutual fund and you're basically buying all the companies or securities inside it, and the performance of the fund depends on the performance of the companies inside it. Now, I hate to give you bad news, but mutual funds are, in my opinion, another investment that you should avoid. The main difference between mutual funds and index funds, which instead are a good investment, is that most mutual funds are actively managed. So the manager is actually buying and selling what's inside the fund based on what he believes to be good investments. Not only mutual funds have a terrible history of performing worse than the market itself, but they are also extremely expensive because, as I said, they're actively managed. So you're gonna have to pay every year a so-called management fee that could go from 0.5% to up to 1 or 2%. And if you think that 1% is not so much, well, think again. If you invest $1,000 in a mutual fund with 1% expense ratio, and you keep investing, for example, $5,000 per year for 30 years, in the end, you're gonna have $353,000. And a mutual fund manager will have pocketed over $71,000 from you, which is not 1%, but 17% of your whole gross portfolio value. Another low-risk option you have is to invest in CDs. Yes, but not these ones. A certificate of deposit is an investment that is more like a contract between yourself and the bank. So you give the bank a certain amount of money, in this case $1,000, and the bank locks it for a certain period of time that you decide. That can be between a month and 5 years, so you won't be able to use that money until the contract is fulfilled, which is also called the maturity date. And after this date, you'll receive your money back plus interest, which will be of course higher if you kept the money for a longer period of time. And the CD is an alternative to the savings account that offers higher interest rates, usually tied up to the inflation rate. But on the other hand, you can't access your money before the maturity date. Number 7 is money market securities. You've probably heard this term in the past few years because during the crisis, money markets were actually offering great interest rates. The money market is a market with fixed income, therefore with a safe rate of return. Focus on short-term debt securities that mature in less than 1 year, usually within 3 months. To explain it in simple words, buying money market securities basically means that you're lending money and you get it back with interest. Usually governments, financial institutions, and also large corporations can get money like this for the short term. And when you buy money market securities, you are financing the short-term debt. They are considered an extremely safe and conservative way of investing, but of course, don't expect great returns from them. Now, an alternative to cash and money market securities is on number 6, which is bonds. Bonds are usually more aggressive than CDs, but you need to understand how they work. The key point to remember is that interest rates and prices move in opposite directions. So in the past 2 years, for example, the Federal Reserve was increasing interest rates. Or as you've probably heard in financial videos, the Fed is tightening. As a result, prices of bonds tend to decline. Now, I personally don't invest in bonds because I prefer more aggressive investments, but if I had to choose one, I'd go with the iShares Inflation Edge Corporate Bond ETF, ticker LQDI, which is probably the best one against inflation, or with VBTI VTLX, the Vanguard Total Bond Market Index Fund. Number 5, and I know some of you here are not gonna like it, or maybe are not even considering an investment, is paying off your debts. Probably the most common debt that is worth paying off is the credit card debt, which can vary, but it's usually around 20%. Now, no matter what your credit card balance is, if you pay it off, you're guaranteed a rate of return on your money equal to the interest rate that you're paying with a credit card. So even if your balance is $1,000, if you pay it off, you can say that you just invested $1,000 with a safe return on investment of around 20%, which, by the way, is the average return of Warren Buffett. Considering that in the stock market you can hope to get 7 to 10% per year in the long term, I'd say that 20% is a pretty damn good return. So if you have debts with an interest rate higher than 5-6%, get rid of those debts right away, because the stock market doesn't guarantee results, but paying off debts always does. Number 4 is investing in small businesses.
Next up is a way to bring on the holiday cheer.
I don't know if that's a great idea.
So what do you want the $150,000 for?
I just don't see how it'd be investable for me. For those reasons, I'm out.
If you've seen Shark Tank, you probably think that these guys are pretty cool. So what if you had the chance to do exactly the same thing that they do, but with smaller investments? Mainvest is a platform that allows you to invest in small businesses, and it works in a similar way to other crowdfunding platforms like Kickstarter, but instead of presenting products, people present their small businesses, and you can decide if you want to invest in them. The process in 3 steps is: fund, by discovering and investing in vetted businesses; track, by checking the quarterly revenue reports; and get paid, by receiving a share in business revenue. You can find many different businesses in several areas, and if you click on one, you're gonna see a presentation of the business, including info about the team and the business model, and you can also see financial forecasts. By some businesses, you can also see the financial statements of the last years, which in my opinion is one of the most important things you need to check before investing. And if you don't like a business, you can simply say,
I'm out.
I'm out.
To everybody who's watching, don't buy it. I'm out.
okay. One thing you can invest on with $1,000 is real estate. And yes, you can do that with as little as $10. Some people think that you need big capitals to invest in real estate, so they never start. And although starting a corporation, getting fat loans from the banks, and purchasing hundreds of condos is certainly more lucrative, if you want to start getting a taste of the real estate market with very little money, there are 2 ways you can go. One is by buying the so-called REITs, or real estate investment trusts, which are funds from real estate companies containing real estate investments. You can buy them with any brokerage like Vanguard, Schwab, or Fidelity, or using a brokerage app like M1 Finance, Webull if you live in the US, or Trade Republic if you live in Europe. By the way, you'll find a link to download Trade Republic in the description below, and if you use it to make your first trade, you're gonna receive a free stock with a value between 5 and 100 euros. Now, another way that you have to invest in real estate is a platform like Fundrise. Fundrise is an online real estate company that lets average investors buy into private, commercial, and residential properties by pulling their assets together. Now, what can you buy with this app? Fundrise offers mainly the so-called real estate investment trusts, or REITs, or the so-called e-funds, in which investors' own money is used to buy land, develop properties, and then sell it back. Moreover, there are other kinds of funds that allow you to diversify even more. Of course, as for any other investment, you can be sure that it's going to be profitable. But on the website, Fundrise shows a really cool graph that shows you the real-time return of all the accounts using this platform. An important thing to say is, while investing in real estate, you must be aware of the risks. And although Fundrise makes investing really easy, you still have to do your own due diligence, because there is no certainty that the projects you invest in are going to be profitable. Alright, number 2 is investing in the stock market. And I want to tell you exactly how and where I would invest if I went back in time and had to invest my first $1,000. If your parents invested just $10,000 in the S&P 500 index in 1983, exactly 40 years ago, and never invested 1 cent more, they would sit now on $795,000. This is a return on investment of 7,852%. Try to beat that. So if you've never invested so far, I would suggest you to open a retirement account called the Roth IRA, which you can do pretty easily from any brokerage account, and gives your investments tax-free growth and tax-free withdrawals in retirement, which is awesome. Now, in the stock market, you can mainly invest in single stocks, which represent companies, index funds, and ETFs. The last 2 are not the same thing, and the main difference is that you can buy and sell ETFs throughout the day like stocks. Now, if I went back in time and started investing from scratch, let's say $1,000, I would first of all put $600 on my favorite ETF, which is the S&P 500 ETF from Vanguard called VOO. representing the best 500 companies of the US economy. If instead you want to invest in the US stock market as a whole, you can go with VTI. Or if you want more diversification, there are also many rolled ETFs that cover all developed countries. And then I'd put $200 on a growth-related ETF like QQQ or a tech-related ETF like VGT, the Vanguard Information Technology ETF. Then around $100 on a value ETF or a dividend ETF, for example SHD or VYM, which on average are gonna give you around 3% dividend per year. And the last $100 would be the so-called fun money to use on individual stocks. So by building a portfolio like this, I would have access to the whole US stock market, to the growth sector, to the value and dividend sector, and I could also learn stock picking, which is usually a painful lesson, but also a very important one. My number one is cryptocurrencies. And please be advised, cryptocurrencies might be the most profitable investment probably in the whole history, but they are an extremely risky investment. You can try it, you can make your own experiences, but my suggestion is to never invest more than 5% of your portfolio in crypto. And for sure, don't invest money that you're not ready to lose completely. Bitcoin was invented in 2009, and it was first in 2010 that it started moving past 10 cents per Bitcoin. Now it's reached a value of $40,000. So imagine if you'd have bought $10,000 of Bitcoin at a price of 10 cents per Bitcoin back in the beginning of 2010, you'd now sit on over $4 billion. Okay, again, it's a really risky investment, and don't get fooled into thinking that cryptos are still gonna give the same returns that they did years ago. But still, I have to put it at number one because during bull markets like now, cryptocurrencies are really one of the best performing assets there is. So let me know what you think about these 10 investment options, and if you enjoyed this video, don't forget to subscribe to my channel and drop a beautiful like. I wish you a great day, thank you for watching until the end, and as always, I'll see you in the next video. Ciao!